Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of other portfolio managers. You should always consult a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, so now that the elections are behind us, it appears that investors have had a lot to be thankful for in November. While many of us were trying to figure out the rules for Thanksgiving get-togethers, stocks had one heck of a month. As a matter of fact, the Dow Jones Industrial Average had the best month since 1987, and the S&P 500 index had the best election week rally since 1932. A lot of news was made in November, which led to such strong performance. It now appears we will have a split government, so we don't have much to worry about in terms of major policy changes. Vaccines developed by Pfizer, Moderna, and others appear to have some very positive results, and we could see distribution of these vaccines soon. And it looks like the federal stimulus package is being worked on. All these factors help propel the market to all-time highs in November. Now, before we get into more detail, it's important to understand the investment process I follow and how it drives my investment decision making. My investment models, at their core, are designed to keep you invested as long as possible and take defensive measures when economic conditions deteriorate, and thereby helping avoid major market drawdowns. As a fundamental analyst, I'm not as sensitive to the day-to-day fluctuations in the market, but I'm more focused on identifying investment themes that are going to help investors depending on the current environment. Now, I understand that market behavior sometimes deviates from fundamentals, so I have to have the flexibility to make changes to reflect these short-term variances. I do so by segmenting the model into two separate components, giving me a better, more complete picture of the current environment. The first component is my longer-term allocation. It's designed to stay fully invested until I see deterioration in economic activity. And the second component is my shorter-term allocation, and its goal is to take advantage of near-term opportunities or get defensive if conditions warrant. Now, looking at this pie chart, the left side is the longer-term allocation with core holdings being dictated by risk tolerance. And as I mentioned earlier, I'll be fully invested here until I see recessionary pressures building or a catalyst appears that could cause a major market collapse. Looking over the next 12 to 18 months, we'll analyze the macroeconomic environment, the current market cycle, and other fundamental factors like fiscal and monetary policy, just to get a better and more clear picture of what's going on. This longer-term view will tend to cause less turnover and thereby be more tax efficient. Now, on the right side of the chart is the shorter-term allocation, where I can allocate to global positions as well as sectors and other asset classes. This half gives me the flexibility to be opportunistic or defensive depending on conditions. If things look bad, I can increase my cash position, or I can turn to bonds if valuations look favorable. I can also overweight or underweight stock sectors, market caps, and others. And finally, from time to time, there may be value in alternative investments that have some unique benefits to the portfolio that'll help performance. A disciplined process is essential to portfolio management. Otherwise, you're going to allow all your emotions and other external factors to dictate your investment decisions, and that usually ends poorly. So let's take a look at my core portfolio and how the portfolio has shifted over the past 3 months. In September, I held about 60% in stocks, 30% in bonds, and 10% in cash. Stock exposure was primarily in tech and large cap stocks, but entering October, I began increasing exposure to stocks primarily in energy and industrials, giving me about 80% exposure to stocks overall. By the time the election rolled in, I increased my exposure to small caps, energy, and industrials, and got to a full stock allocation. The decision to get fully invested was predicated on my view that the virus will soon be behind us, the economy will reopen, and additional stimulus is on the way. All these factors point to a better stock performance going forward in small caps, energies, and industrials. So now let's take a look at how these themes played out in November. Here we have a chart showing the S&P 500 index in black, the bottom line. Energy is the top line in blue, small caps in red, and industrials in green. As you can see, energy outperformed the S&P by over 17%. Small caps were better by 7.5%, and industrials beat the S&P by 5.5%. The allocation of these sectors allowed the stock portfolio to outperform the S&P by nearly 3% in November. So all good news on our front here in the month of November. Now, active management is going to be crucial in 2021. The stock market has 11 sectors, and their performance really depends on where we are in the economic cycle as well as the market cycle. Here we have a chart showing how small caps, industrials, and energy performed 2 years after the last recession. As you can see, all three of these sectors and areas of the market outperformed the S&P 500 index by a wide margin. And while past performance is no guarantee of future results, I believe these areas of the market should do well as the economy heals and earnings expand following the deep recession we just experienced. So to conclude, I think active management will matter in 2021. As I mentioned before, not all sectors are going to behave the same way depending on where we are in the market cycle. So you need to be selective when you allocate your investments. An investment strategy that doesn't have a disciplined process behind it is just a guessing game that allows emotions and other external factors to dictate investment decisions, which usually results in bad outcomes. And finally, the easy money has been made. The next 6 to 12 months will not be easy. Remember, investing is much more than just picking stocks or bonds. It requires a thorough understanding of economics, corporate finance, asset valuations, and portfolio construction and management. How you analyze these factors is going to determine your outcome. And remember, you don't need to do this alone. If you're a bit worried or confused on what's going on in the market, we can certainly help. Just send me an email or give me a call. I hope you're all of you stay safe and have a wonderful holiday season. I also want to say goodbye to 2020. It's certainly been one heck of a year. Thanks again for watching, and I hope to see you next year.